The domino effect is hitting, and markets may never recover. I'm Steve Van Metre. Consumer spending is tanking, sentiment shaky, and Trump's blasting China's trade moves. As you're about to see, it's the worst since 2009. Now let's over to Bloomberg, where he picked today's story up with a headline. As U.S. consumers hit the brakes while goods imports sink by a record. And the real story here, it's all about the consumer, because in a consumption-based economy, when consumers stop spending, it doesn't matter what monetary policy is. It doesn't matter how many goods are coming into the country. When consumers stop spending, it's game over. And what we're facing now is the worst financial situation since 2009. Inflation-adjusted personal spending rose 0.1% after rising 0.7% a month earlier. So keep in mind that inflation-adjusted spending is a really big deal, because you want to see this number going higher and higher every month, because what it means is that consumers are getting ahead of inflation. And we've been talking about how the cure for higher prices is indeed higher prices. At 0.1%, well, it goes to show consumers can't afford any increase. Separate data showed an almost 20% slump in imports, leading to a massive narrowing of the U.S. merchandise trade deficit in April. But we already knew this was likely to happen, because we already saw from the Port of Los Angeles that incoming ship traffic was dropping by 30%. We know it's likely to get even worse from here. So yes, we're solving the trade deficit, but the problem is, with all of consumer finances looking very bleak, what we're facing is potentially the next big financial crisis. And let's turn to this slide of the consumer price index against the personal savings rate, because the real issue is when consumers cut back on their spending in a consumption-based economy, well, it's game over for inflation. And as you're about to see, it's game over for the economy. Let's go back to the 80s, and what do we see? The personal spending rate in red is rising. What happens? We already know the consumer price index was heading higher, but we do know that wages weren't keeping pace. Next thing we know, the inflation the Fed was worried about turned into a massive bout of disinflation. We've seen the same effects going into the dot-com bubble, as consumers said, look, we have enough. We can't afford higher prices, so we have to start saving more. Of course, that led right to the dot-com bubble. We see it happen again going into the financial crisis as energy prices were soaring. Consumers, again, couldn't afford to continue spending on the discretionary side of the economy. They started saving, and that led to all-out deflation. And then you can see pockets here around 2012, 14, and even around 2019, where inflation gets reversed hard because consumer spending tanks as savings rate soars. And now we're facing the same scenario. Consumers saying, look, we can't afford higher prices. We have to save more. And so this notion that inflation is going to skyrocket, well, it isn't very practical, because a lot of people believe that business owners are just going to continue to increase prices. But keep in mind, if the merchandise on their shelves don't move, well, you don't have any latitude to raise prices. Meanwhile, the Federal Reserve's preferred price gauge remained tame. The personal consumption expenditures price index, excluding food and energy, increased 0.1% from a month earlier. So now we see from, the Fed's preferred gauge of inflation. Remember, the Fed is completely worried that inflation is going to skyrocket here, and we said the odds of that are very low, even though we believe there's a possible chance we'll see a one-time jump in prices. But the real issue we're facing right now is that incomes relative to inflation, they're shrinking even faster than we thought, and the evidence is now clear. Not even the PCE is hardly rising. In fact, the core gauge rose 2.5% from April 2024. That's now the smallest annual advance. So we continue to see both the headline personal consumption expenditures and the core. Again, these are the Fed's preferred gauges. This is what they set monetary policy on. And remember, the Fed's line in the sand was 2%. And what we're seeing from the data, we're quickly getting there. The problem is the Fed says they're standing pat. The reality is they're going to be late once again. And let's take a look at the effect of the personal consumption expenditures chain price index, that's shown in red, against the consumer price index, that's still shown in blue. And you can see the very strong relationship between the two. The real issue here is where the PCE goes in red. The CPI tends to fall. Right now, what we're seeing is personal consumption expenditures leading consumer prices to the downside. This is not something consumers thought were going to happen. A lot of businesses said, look, we're going to raise prices. What they found out, every attempt to raise prices gets rejected, and what we're now facing is the worst financial situation since 2009. When that happens, what you're going to see, consumers cut their spending. Next thing you know, it's going to hit the labor market, and watch out when the delinquency rate soars. American spending moderated in April as U.S. businesses pull back significantly on imports after a month of pulling forward economic activity to avoid tariff policy. But this only adds the uncertainty around the economic outlook at a time when trade policy changes on a daily basis. And yes, that is an issue, but something that should not have any uncertainty. Well, that's your trading account. Check out this trade that we put on back on April 24th on uranium. You've seen this. This is real data. Our subscribers got stopped out on May 29th for a 35.7% gain. How do we do that? Well, we trade against the machines. We look at how they're positioned, and we try to put our subscribers ahead of a big buying opportunity and get them out before prices plunge. If you want to know how to do that, grab the links in the description below. Use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Because while there's uncertainty at the business level, well, there's even more uncertainty at the Fed. Because Fed policymakers will likely keep interest rates unchanged for the foreseeable future until they get more clarity on the impact of tariffs, not only on prices, but on also other pillars of the economy like the labor market and consumer spending. And this is a huge problem because we just found out, as we've been saying was going to happen, that if prices go up and wages don't increase in a line, what's going to happen is consumers are going to spend less. So we're now seeing that in the data. Consumer spending going down. And what is the impact on the consumer price index? Well, we know businesses would love to pass on higher prices. The problem is they can't, and they know it. This is an issue for the Fed here. I think they're way behind the curve. I think they should be cutting rates here. What do you think? Should the Fed be cutting, hiking, or just getting their head in the sand like they normally do? Weigh in the comments below. I'd love to hear from you. Because the bond market's telling the Fed very clearly, look, you got to be cutting rates here. As we look at the personal consumption expenditures index, you can see it's headed right toward the Fed's 2% target. If we overlay the funds rate in blue against two-year Treasury yields in green, what do you see? Two-year Treasury yields are clearly telling the Fed that, look, you need to be cutting rates. And what did we see in the auctions this week? We saw a 2-year, a 5-year, and a 7-year note auction that were met with strong demand. The market is clearly telling the Fed, you're behind the curve. Your thought that inflation was going to soar? Well, no, you got another problem. Consumers are stopping their spending. When that happens, not only do we see price pressure abate, you see disinflation. The next step happens, you see hours get cut, jobs are lost. That tells me, my friends, Fed way behind the curve here. And while many companies have so far been absorbing or offsetting much of the hit from tariffs, because we know they're unable to pass those higher costs on, retailers including Walmart and Macys have indicated Americans will start seeing price hikes soon. But based on this slump in consumer spending, based on the fact that consumers are starting to increase their savings rate, what it's telling us, yes, they're going to buy some of those things when the price goes up, but you're going to watch. They're going to cut their spending. They're going to focus on goods and services where there's no price increases, and that means all these companies attempting to increase prices, I think they get rejected. But what do you think? Weigh in the comments below. Are businesses going to be able to pass on higher prices, or are they soon going to be cutting them when they find out there's no demand? Excluding government transfers, personal income still advanced at a healthy pace. Nominal wages and salaries rose 0.5% for a third straight month. But here's the big one, the savings rate. See, it doesn't matter if incomes go up, because in a consumption-based economy, you can see incomes rising all you want. But if people aren't spending money, well, that's the problem. And that's why the issue here, the savings rate increased to 4.9%, the highest in nearly a year. What consumers are saying is, look, not only are we worried about rising prices that we can't afford, we're worried about our jobs. And that's why, my friends, as you're soon to see, this is the worst setup since 2009. It's a dangerous scenario, and right now there's no evidence it's going to get any better. And here you can see the effect of a rising personal savings rate on incomes, because again, it all comes back to consumption. When consumers cut back, that affects other people's jobs. And this is something I believe people are very much aware about. As we look at the personal savings rate now shown in blue, you see it on the uptrend here in late 1999 going to early 2000s. What happens? Demand drops, and weekly hours of production of non-supervisory employees in red, that goes down. You see the same effect going into the financial crisis. As the economy starts to cool off a little bit, consumers start to save. What happens? That means, of course, other people rely on that spending for their income, saw their hours start to get trimmed, and the next thing you know, right into a financial crisis. We see it happen right around 2012 into 2013. We see it leading into the pandemic, and we see the effects now. Then this is the issue here. We did see a jump in hours worked, but one of the things I believe is happening here is a lot of people are cutting their spending. You know, they're talking to their friends and their family, their coworkers, and everybody's doing the same thing. They're cutting back their spending, and the reality is when they go to work, they realize that if everyone's cutting their spending, it's going to have a financial impact, and that's why we're seeing now in the surveys, consumers are saying, look, this is the worst since 2009, and that's not a good place. As U.S. consumer sentiment recovers in final May Michigan survey, this is where we see the red flags popping up. The 52.2 final May sentiment index marked an improvement from the preliminary reading of 50.8. Now, why did we see an increase? Because there was this impression that the trade war was coming to an end. Of course, we found out today that President Trump is saying that China is not playing ball the way he sees fit. Of course, we're going to see sentiment plunge on that notion right alongside with the market today. We'll follow up more on that here in a bit. It was unchanged from April, one of the lowest levels on record. And so this is the real issue here. Consumers are losing confidence. It's not just about their finances and their jobs. It's about how they spend money into the economy. Because when people lose confidence, what do? They start saving more, spending less. And think about this from the business side of the economy. They built up massive inventories. They front-run the tariffs. They gave people more hours. And they said, look, we're hoping everything's going to work out. What are they actually finding out? Consumers can't afford higher prices. Now they're sitting on massive amounts of inventory. Sentiment is plunging. Of course, we already know when that happens, retail sales are going to go right down with it. But let's take a look at what it means for the average worker in terms of their paycheck. Let's take a look at the University of Michigan Consumer Sentiment Survey in blue. We're going to overlay the average weekly hours of production of non-supervisory employees in red. And you can see as consumers lose confidence here in the mid-80s, what happens? They cut back on their spending. And next thing you know, for businesses, demand goes down. And then that means demand for labor drops, hours get cut, paychecks continue to shrink, and eventually you go right into the 91 recession. You see the same thing happen in the late 90s. Consumers get a little bit of confidence there, but confidence doesn't translate into more income. Next thing you know, confidence is plunging, spending plunges right into the dot-com bubble. Same thing happens in a financial crisis. And if we look at now in 2022, everybody thought because the stock market went up, everything was going to be great. Confidence came plunging down. And what is that telling us? That workers can see the writing on the wall. They know they're cutting their spending. They know other people are cutting their spending. And they're looking at what happens when they go to work. They find out there's not a lot of business for them to do. There's not a lot of backlogs. And they know at some point it's all coming to an end. And right now, the first effect they're going to find out is their hours are going to get cut. And then it's going to be their jobs. And consumers were also more sanguine about the longer-term inflation outlook. They saw costs rising an annualized 4.2% over the next 5 to 10 years, down from 4.4% in the prior month and the first decline this year. The reality is prices aren't going to continue to increase because, again, if you have a product and you raise the price and you can't sell it, you don't continue to raise the price because at some point, you're out of business. That means, of course, consumers' impression of inflation completely out of line because what are we seeing in the CPI? What do we just saw in the PCE? Disinflation here, and that's not a good sign because what consumers really need, they need more wages, they need more hours, and employers are looking to look at this. If they have to start cutting prices, it means they're not going to give out big wage gains, and they're certainly not going to give out more hours. They're going to be cutting hours and slashing jobs. The survey showed income expectations remained weak and respondents were still concerned about the possibility of losing their job. A gauge of sentiment about current personal finances fell from a month earlier, and here's the big one, my friends, the lowest level since 2009. So right now, people are looking at their finances. What are they facing? They took on a lot of debt post-pandemic to keep up with inflation. They bought into the fact that the economy was going to turn around, and what are they finding out? The economy isn't turning around. They know the reality is coming. They see demand is going down because they're cutting their spending. They know employers are going to start cutting hours, and soon. Doesn't matter if prices go up because shrinking paychecks at this point is enough to do the damage. Now we're facing, again, the bleakest situation since 2009 on a personal finance level. When you get at that point, what it means is the delinquency rate is going to start rising. And of course, that means we're going to see defaults hitting. When that snowballs, watch out. It's game over. Financial crisis 2.0. Here we come. And Trump says China totally violated the trade agreement with the U.S., and this sent stocks and energy prices tumbling across the board. Bond prices rallied a bit today on the news, as what this is a sign of is a risk-off scenario, because the reality is everyone's been buying stocks on the hope that Trump is going to get a lot of deals through, the economy is going to turn around. I've continued to say the risk right now to the U.S. economy that's already slowing down in line with the global economy is that this trade war persists. Everyone wants to see it done and done fast, but if it's not, watch out. The agreement earlier this month buoyed investors who have been eager for Beijing and Washington to find an off-ramp from their tariff fight, which has roiled markets and threatened to spark a global slowdown. But since the deal, U.S. and China tensions have flared again, and that's the real issue. If the world's largest exporter and the world's largest importer can't make a deal, all bets are off for the global economy, and that's why we're seeing the reactions in the market. But one of the challenges, we've seen consumers buying every dip. We've seen investors eager to buy stocks because they believe things are going to change. What's called, according to Trump, is negotiation. What investors are calling it is taco. It's called negotiation, Trump said. We set a number, a ridiculously high number. We go down a little bit. It's just part of the talks. But in response to the taco trade, which investors seize on market tumbles after the president makes tariff threats, predicting he will ultimately relent and equities will rebound. The acronym, which stands for Trump always chicken out, was coined by Financial Times columnists and has since been adopted by traders attempting to navigate the dozens of changes to tariff policy that Trump has announced over the early months of his presidency. The thesis behind the taco trade is buy the Trump tariff dip. Essentially, Trump has proven to investors that he won't actually follow through on his draconian tariffs. As such, any sell-off following dramatic tariff threat should be bought. I want to know from you, are you a taco trader? Are you buying today's dip? Because this isn't about backing down from the trade war. This is about the actual economy. And when you start to realize that we're having a trade war amidst a slowing, not only U.S. economy, but global economy, the margin for error here is super small. Either we get this right and everything turns around, get this wrong, the whole world plunges into a recession. Now, one of the reasons we're also seeing a hit to the stock market wasn't just due to that. It was also due to investors being spooked after a Gap tariff warning, as Gap Inc. shares plunged in pre-market trading after the retailer warned its earnings relief of a potential $300 million hit from tariffs. Gap Inc. shares plunged in pre-market trading after the retailer warned its earnings release of a potential $300 million hit from tariffs. And we've been warning there's a couple potential outcomes here. One of them, if companies absorb the tariffs, which is what consumers said they wanted. They wanted everyone else to absorb the tariffs. They didn't want to see any price increase. Problem is, if companies are seeing their earnings decline, well, it means stocks are going down with it. The retailer sources much of its clothing from third-party manufacturers, primarily located across Asia, regions heavily impacted by the trade war, while selling the majority of its merchandise in U.S. stores. The warning comes amid a 90-day pause in the U.S.-China trade war as both countries engage in bilateral talks to craft a deal. So you can see the market reaction day when Trump said that China totally violated their deal. This is a serious issue. This is why the market's reacting the way it is, and this is the risk going forward. Everybody wants prices to stay the same, but the reality is it means the markets may not stay the same. So now you can see why consumers are saying this is the worst since 2009. It's all about their finances. It's all about their ability to spend and the labor market. And if things don't change and fast and turn this economy around, we could be facing the next big financial crisis. But just because the economy could come plunging down doesn't mean your trade account has to go with it. Let's talk about our CTA Timer Prop because we nailed a massive trade on uranium. Now, how did we do this? Well, we saw based on our reports that the machines could be big buyers of uranium. We positioned our subscribers ahead of that. We gave them risk control levels and we raised those along the way. Now, we look at machine positioning across the broad equity, bond, currency, commodity markets, and we run a historical overlay. So what we find out is when the machines are mispositioned based on where they should be, well, that triggers a signal on a report. Even better, we back tested all those signals so we know which ones have a high probability of putting money in your pocket. And again, that reports on our hot list each and every day. But in addition to that, you get the machine position across all the broad asset classes. In addition, you get the daily report, the tradable signals, my opinions on the best trades. That's right, I review each and every one of them. We give you risk control levels, a full tracking of our trades and returns, a weekly update. And here's the best part, we have a 30-day free trial. That's right, we don't want you to put a dime out for your first month because we're so confident that you can make money trading our reports. We want your first month to be on me. Grab the links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.